CA Lamiya Bhatri, Bachelor of Commerce and Chartered Accountant, member of Institute. She also has over 15 years of post-qualification service, post-qualification experience, and mainly in the field of accounting, audit, assurance services, which is very relevant to our today's topic. As a part of audit experience, she audited various financial services, companies including private equity, non-banking financial corporation, NBFCs, and banks as well. She is currently focusing on accounting, auditing, corporate law, and other related matter within the external audit, and has conducted various training sessions, both within the firm internally as well as on the various forum. With these few words, I welcome you, CA Lamiya Bhatri, and request to all of you to carry with the round of applause. You can start now. Answer. I request CA Vipulji to come forward to honor the with memento. And also one more thing I forget, she is going to cover NFRA, about the NFRA's review of NFRA's order coming, very important topic for the today. Please.
Thank you for the introduction. And this makes me conscious, but I'll try and keep to time. We have our lunch break, I think, at 1:15, but broadly in the next one hour, what I plan to focus on is over the last 12 months or so, there have been over 50, approximately 57 NFRA orders, if I was to take it from April 2023. And probably summarize some of the common themes that we've seen across these NFRA orders. What is that is being highlighted? Is it something out of the ordinary, out of portion, as we understand from CA? Or is it something that we are required to do as per our daily tasks as an auditor? So that's something that we will concentrate on. And as well, understand what we are required to do and what NFRA is highlighting that as an auditor we should have done for some of these observations that have been put forth in the orders that have been issued publicly. So I think the theme, what we've seen over the last 1 year, and it's been a learning for, I think, all firms, big, small, medium, large, on really, what are we talking about when these NFRA orders come out, and is it really earth-shattering in a way that, there is an order which has come out, and what are they highlighting? But I think what we've learned over the last 1 year is NFRA is really concentrating on the basics. And like Meghdut highlighted in the previous session, it's basically whether you follow your accounting standards appropriately, whether management or the auditor. And we are talking about both the responsibilities here, as management as well as the auditor. You're following the accounting standards, you're following the auditing standards, because that's also within the law to be followed. And lastly, all the other regulatory requirements which need to be followed as per Companies Act, etc., have been looked at carefully, and everything is then reflected in your file, which is then submitted to NFRA for their inspection. So can you evidence that you have done that work that you are saying that you have done? So that is the general theme of good governance and good documentation, etc., which NFRA has brought out in each of their orders. So if I look at a normal NFRA order and I'm reading it, very briefly, they start off with the summary of the issues that they have identified for that particular company and that particular company's auditors. And then they go into a summary of, how they've gone about the work and etc., explaining how NFRA kind of governs these inspections. And then they go into details of each of these observations that they have come across. So anybody from a reader of that order can understand really what the issue was, so that you can apply it in other cases too. And lastly, of course, if there are any charges, penalties, etc., that is what they bring out in the order. So that's not really what we will concentrate on. We will concentrate on what has been highlighted and what we can do better as a learning from some of these highlights of the NFRA orders. Let's go into the first observation, and I think Meghdut has kind of explained this really nicely in the first session, and I'll just build on that and what really were some of the issues that were identified from a going concern perspective. Now, what happened in a few of the cases, the orders which were issued by NFRA, they basically were very basic. They said that as a company, the company was facing losses, continuous losses year on year. So they had an accumulated loss position for a few years, right? The net worth was completely eroded. That company was debt-ridden. They had external debt. When they looked at the ratios of the current asset, current liability, etc., that company did not have funds to meet this immediate external debt. In some of the cases, there were also debt covenants which were breached. Now, all of these, what NFRA basically says, were negative indicators, and this should have been kind of investigated further. What happened is they did ask the question of whether this was looked at or not. And although we may have done our work, we may have looked at, had the conversations with the management, etc., nothing was evidenced in the file that we had taken that information, we had had those conversations, we had validated, we had appropriately assessed, verified, etc. So they said that the work had not been done. That was one, with respect to work papers. Second was with respect to the reporting in the audit report. Now, in some cases, what happened is there was nothing mentioned in the audit report of whether there was a material uncertainty or, there was something that what we called a close call, that there were indicators, but even the company, we did our assessment, they have enough cash flows in the future, etc., and this is mitigated. So there was no disclosure in the financial statements also to that respect, so it was a complete silent kind of thing. So they said that we don't see anything in terms of reporting. If it was an MUGC, material uncertainty, then that should also have been brought out in the auditor's report, which again we don't see in terms of the report. So these were some of the issues which repeatedly got, I think it was the same theme that got reflected in almost 5 or 6 orders with respect to going concern. Now let me come to my next slide, which is basically where we then talk about how we can not have such observations when we are doing our audit. And practically, frankly, if you ask me, going concern is something that should be discussed right in the beginning in the planning meeting. When we have, when we meet the client to start off our audit, I think this is the first thing that we should be comfortable with before we even start the audit, that, there are no negative indicators, there is no concern. And if there is, then I think we need to go further and inform the client that they need to do their assessment, first of all, and assess why they feel there is no going concern issue, and then of course come to the table and agree on whether we are okay with it, we are not okay with it, and where we are going to go with it. So from management's perspective, they have a responsibility, first of all, to do their own assessment of whether there is a material uncertainty or there is no material uncertainty. Even the standard of auditing, which is 570, basically says that first management has to do the assessment, only then can the auditor review that assessment. We cannot be doing management's work to come up with the assessment itself. So I think that's a very important point, because that was very basic to know that management needs to know their responsibility. Of course, once management does their assessment, those are reviewed by those charged with governance, because it is their responsibility to review it. And then, of course, the auditor verifies, assesses, and agrees to whether that management assessment is okay. So along with that, I think the other important thing is that if it comes to a situation which is a close call situation, a material uncertainty situation. As per the standard, you are supposed to give a disclosure which gives enough information about what those indicators were, how it got mitigated, and finally whether there is an explicit statement of whether there is a material uncertainty or things have got mitigated. So if there is a material uncertainty, there needs to be an explicit statement in that disclosure by the management first to say, yes, there is a material uncertainty and we will not be able to meet our assets and liabilities as and when they fall due. This is most of the time missed in a disclosure because the management is not willing to make that statement, although they've had conversations with you and they've agreed that yes, there is some kind of uncertainty. But it needs to first reflect in their FS before we bring it into our audit report. So that was the first thing that needs to be done from step number 1 by the management. Then comes our part. From our part, what we get as part of the management assessment and what we should get. One is, of course, the cash flow forecast for the next at least 12 months from the reporting period. and of course, their assessment of the negative indicators and how those are mitigated by, say, business plans, various stress scenario forecasts, etc. And put forth to us in terms of are we okay with this or not. From our part, do we accept that as it is? Probably not, right? We are supposed to challenge those assumptions, challenge those business plans, challenge whether the growth rates, etc., which the management have indicated there, seem plausible or not. So that is the first kind of challenge that we need to do. How do we get that? I think first, importantly, is business understanding. We need to understand the company, which business it's running in, which industry it's running in. Are there problems in those kind of industries today? Are there any new regulations which have come out which will kind of, affect the business, etc.? So to give you an example, probably we were doing a going concern for one of our software companies, the assessment. And just when we were going to sign the financial statement, the engagement team realized that there was an RBI circular which came out, which basically contemplated stopping import of certain licenses, etc. And these licenses were something that the company was trading in. They needed to import and then sell it in the domestic market. Now, if that happened, basically what when they discussed with the management, it would stop the whole business of the entity, and they did not have any other business to run after that. Of course, this RBI circular was a draft circular. It had not been finalized. So there was still, to and fro in the whole regulatory market of whether this would go, not go through, etc. But something like this coming out needs to be questioned, for example. I mean, it's just an example. I'm not saying that this would lead to a material uncertainty. There may be mitigating factors which then say, okay, these people have enough liquidity, enough cash flows, etc., to run to the next market, and that was a fact. They had enough inventory, stock, etc., which would help them to run for the next 12 months. So there are mitigating factors. It's not the end-all conclusion that everything leads to material uncertainty. So, but things like these need to be challenged. And that is really what NFRA in their orders have also said, that there is lack of challenge when there are indicators, that there is lack of questioning which is happening. People have not looked at the cash flow forecast. Do they make sense? Do they not make sense, etc. Another important thing is when these cash flow forecasts are there, they should be at least for the next 12 months from the signing date of the financial statements, not from 31st of March the year end, because sometimes the 31st March, or at least for private entities, are signed much later, 3 or 4 months later. And then you realize that the forecasts are only for the next 6 months, just till December or March that you have received, and that may not be enough to validate whether that company is going to run for the next 12 months. So that was that is the other important thing which is missed. The other thing is when you have such close call scenarios in some of these business and cash flow kind of situations, it's important to do a stress test, what we call a stress test or worst case scenario, right? Question is that you test it for, say, if we assume a 10% drop in revenue, or we assume 5% drop in revenue and expenses, then does this company still, is there still viability that they would continue? Now, if you get a negative outcome out of that, then you again have to do further procedures and say, what is mitigating and what is okay, what is not. Is this stress percentage that we've taken viable, not viable, etc. So procedures need to be done then once you've taken assumption to that respect. I think the last important thing is your audit file, however maintained, whether digital, etc., needs to have all of this information in it. Questions asked, discussion with those charged with governance, discussions with management, everything needs to be there in terms of minutes, documents, the assumptions, etc. you have challenged, and how you have closed with whatever final discussion of going concern you have reached on. Because again, if not in the file, it's not evidenced and it's assumed you've not done the work, right? And lastly, disclosures, right? Reflecting whatever you have discussed, concluded appropriately in your financial statements, and then eventually in your audit report if required. So for example, if it is a perfectly healthy company, there is no problem, there is no going concern, you would still get a management assessment. You will still conclude saying, okay, everything's okay and we have no issues and we don't need to do any additional procedures. And nothing would get reflected anywhere, either in the financial statements or in the audit report, because everything's good and nothing needs to be highlighted. In case of a close call scenario, there would be a disclosure that the management is required to give in the financial statements, and that should definitely come out, which indicates what were the issues, what were the negative indicators, and how those are mitigated by the management, and therefore they have concluded that there is no going concern issue, and we will be able to meet our assets and liabilities as and when they fall due. Whether anything gets reflected in the audit report there, it really depends on how close that close call is. So for example, as an auditor, we feel that some negative indicator and is very strong, that there may be a gray line between the mitigating factor, mitigating it at this point of time, but something can go south, say 6 months later. You may highlight it as an emphasis of matter. But that is only emphasis of matter, nothing beyond that. You basically bring out the reference in the note and say these were the indicators, and we feel that this matter is important enough to highlight to the users of the financial statements. In the third scenario, which is the MUGC, like I said, there needs to be an explicit statement in the financial statements by the management saying that there is a material uncertainty, and we may not be able to realize our assets and liabilities as and when they fall due. In our audit report, Meghdut had put up an example. There needs to be a separate paragraph which has a header saying material uncertainty over going concern, so that the readers of your audit report know that there is a material uncertainty, and we basically highlight saying that this is the reason why there is material uncertainty. And of course, where there is a disclaimer and an adverse, it follows the respective standard in terms of disclaimer that you were unable to get, there was such material, multiple uncertainties that we are unable to conclude. And the next one is that we think that there is no going concern, but, and the financial statements should be prepared on liquidity basis, but they are not prepared currently because the management has assumed a going concern basis. So basically that's how One, it reflects in the financial statements and then in the audit report, and this is basically the theme of the whole NFRA observations on going concern. Any questions on this one? And the primary thing to be followed is SA 570. SA 570 has all of this, which I just explained, written in it. Right? So management have to do their assessment, auditors need to challenge, and finally things need to get disclosed both in the financial statements and the audit report, whatever is the concluded.
So, I don't have a question, just a reflection. NFRA had a very valid observation that this going concern issue is not addressed adequately by the management and the auditors. Any reflections as to why this happens, why people miss out? So far as the management doesn't want to do what they have to do, but why do auditors miss out? Is it because they lack professional skepticism? Is it because they don't do exactly what they're supposed to do? There is a 570, is it juniors, relatively less experienced people are assigned to do this kind of work? So what exactly is the
Sure.
reason, and how are the big four, big five, big six thinking about addressing this issue?
I mean, putting it very simply, I think audit itself has evolved over a period of time, right? When we used to think about going concern, probably as an engagement team, we were like, we've taken up the audit of the company. Of course, the company has to be healthy. It's a presumption in our mind that there's nothing wrong with that company if you're auditing it and you've taken it up as a client. Secondly, I think standards of auditing was something that as a profession, like, I think Bipin said initially, we concentrate more on the accounting standards rather than reflecting on auditing standards and the steps that we need to do with respect to complying with our auditing standards. So 570 somewhere it was there, but nobody was looking at it. And this was a culmination of that. So then once you came in the last week before you have to sign the audit, you suddenly realize, oh my God, I have a work paper to do on going concern, and how do I do this within the next 2 or 3 days? And that's really how audits were done previously. You tell the management, oh, is there anything that I need to know, etc., and then that's it. Secondly is we have human nature as a habit to believe the person or the person who we are auditing, right? So they tell us something, yes, these are the forecasts, these are the business plans, etc. We accept them at face value. We do not think of applying our professional skepticism, our challenge, and kind of looking at it twice to say, are these numbers correct? Do they reflect something that should be there in the things? I think it's a culmination of human nature and the way we have been kind of conducting our audits. We need to take all of these seriously right in the beginning. Like I said, when I started off, going concern is something which should be a discussion right in the beginning with your client. That's the time you highlight to them, this is something I'm going to look at, and this is something you need to look at first before I look at. I think repeatedly we also had situations, and again across firms, where we used to not take the management assessment. It used to become our responsibility. How do we close going concern? Because we need to put we need to put a document in the file to say, yes, this company is going concern. So we don't put the responsibility back to management, which has the primary responsibility here. So I think that is the other problem, that don't make it our problem. It's first management's problem, and then we are just supposed to challenge what management has assessed, and then appropriately report it in our audit reports. So management has the first responsibility, and we have the responsibility to audit it. Okay, let's go. This is the second major theme of topics, and a very delicate issue when we deal with even, in our audits, etc., which is related party transactions. If we look at it from Indian GAAP or we look at it from Ind AS, I think the standards are pretty similar. There's nothing drastically different. in terms of understanding what related parties are. But the problem these days is that related party is covered under various regulations. And it's very important to understand that we need to make sure that all of these regulations are met when we are auditing related party standards. We have related party which is defined in Companies Act. We have various sections, section 177, 179, 186, 188, again which deals with transactions with related parties and where various approvals need to be taken place. We have SEBI now, which has come out with Regulation 23, again for public companies in the LODR, again dealing with related party and where and what and how approvals are to be taken. Of course, we have accounting standards which deal with it, which we used to primarily only look at, right? And we have an auditing standard, which is SA 550 on related party, which also we need to look at in terms of audit procedures, etc., which need to be done. So I think important to understand that when we do related party transactions, of course, we need to look at compliance with Ind AS 24 if we are Ind AS, or accounting standards if we are still Indian GAAP. But it is also important to look at the auditing standard to make sure that we have met all of these and done the required procedures which are mentioned in the auditing standard. But also importantly, I think which was missed, and these were some of the observations which came across in NFRA orders, was the approvals which were needed as per Companies Act. So when you make the loans and investments in your subsidiaries, in your related party, etc., you require board approvals, you require audit committee approvals, etc. That was something that was missed. There was one situation where a interest-free loan was converted to a capital advance. Again, you need certain approvals there as per the Companies Act. You just cannot do it blatantly without any approvals. So all of this was something that NFRA kind of highlighted, that you need to look at the full gamut. You don't only need to look at your accounting standard. In some situations, NFRA also, if we come to the accounting standard, they said that the companies had not disclosed the transactions which happened during the year. All they disclosed was the outstandings. And this is specifically required under the Ind AS and AS standards. So this was something which was missed. So it was a miss of disclosure. If there was a miss of disclosure, the auditor should have reflected this as a qualification in your audit report, right? Not complying with an accounting standard. Then the others were, basically there was, we had given an interest-free loan. The company had given an interest-free loan to a subsidiary, and there was evergreening, which is basically round-tripping of funds which happened. So what NFRA basically said is that the auditor did not question the business reason of giving these funds, why they were given, the terms and conditions, why was this loan was given without any security. So why was it given without security? Again, we have, Section 143 in Companies Act, which is prejudicial. You're supposed to assess whether something is prejudicial to the terms of the loan, prejudicial to the interest of the interest of the holders. So that was not done, right? If a loan is given without a security, is it at arm's length? All of those challenges were not done, and therefore there was round-tripping of funds. When further investigation happened, and evergreening, and that money came back and was reused basically in the company. So these were some of the observations which NFRA said were, again, if you think about it, right, let's pause and kind of reflect on all of these observations. This is everything that is already there. There is nothing which we are talking about which is not there in our auditing standards, in our accounting standards. If we follow it in spirit, we look at everything in spirit, I don't think there's anything that the regulators are telling us that you should be doing extra. They are basically just bringing to light things that you should be looking at and you are not looking at, right? So that was really the reflection of NFRA. Now what can be done, right? Again, to every story, there is a management responsibility first. Absolutely. Absolutely. Yes. Then you have FEMA come in, right? You have your RBI and FEMA come in and all of that. Because then your funds are going out, funds are coming in, all of those kind of, yes. So definitely, there are various regulators which then come in as and when you expand your horizon of related parties. So I'm not saying that we are only restricting this to India. There could be global, and then of course we have to keep in mind the regulations with respect. So FEMA is a very common issue actually. You have trade receivables, trade payables, which don't get paid for a long period of time, and then it leads to FEMA implications because of that. So again, that needs to get reflected back in your audit report, because that's a non-compliance of law, and SA 250 requires you to report under that. Okay, so coming to first management responsibility, right? Like I said, it is management responsibility first. You will audit what management has assessed. So it is management responsibility to determine the scope of the related parties, what falls in, falls out, completeness, whether they need to get all the approvals which are required as per the audit committee, as per the board of directors, etc. That needs to be done on a timely basis. This is all management responsibility. I briefly mentioned section 186, specifically where you made loans and investments, and this is a common transaction that happens in private companies as well as public companies, where you need to comply with and you need to get the required approvals where it does not match some rate of interest, etc., etc. So important part, I think, briefly to reflect on is there are Companies Act requirements also which need to be complied on. If not, then you need to reflect that back in your auditor's report. What do we do as auditors, right, when we go to audit related party transactions? I think very important, first, understand your company structure, the whole organization structure, the investments, the promoters, who is involved, how they are involved, etc. I think that is very, very basic and very understanding from a business relationship and transaction purpose. Bank statements need to be looked at closely. Bank reconciliations, bank statements, etc., on who you're making payments to, what payments you're getting from where, etc., which can also help you in reporting transactions, completeness of transactions for the period. I think the third bullet is probably the most important. Apply professional skepticism. Do not take things at face value. And this will mostly help you where round-tripping of funds or evergreening, etc., are some cases which are seen in the industry. I think people have got very innovative in the industry on how they can round-trip and structure funds to come back to the entity, right? So I think it's important to apply that professional skepticism to see how the funds finally went through and got utilized, if they were given in terms of a loan and investments. So apply professional skepticism. Do not stop from asking your questions. I think as an auditor, we have a right to know what funds have gone and where they have gone within the group. Approvals, obviously, you will look at whether they were done on an appropriate basis. Like Sir highlighted here, it is also important to know whether all regulations, etc., were met with respect to these related party transactions. Whether your Companies Act requirements were met, whether your FEMA requirements were met, etc. And I think a great help here, if your company has internal auditors who do this who do daily transactions and audit the daily transactions or concurrent audits, etc. Look at those reports, because that is something which will help you in terms of coverage also, right? They do have certain scope in terms of related parties, how this works in group entities, etc. So I think that is a great helping point from external auditors' perspective. Completeness is something, again, we need to question and make sure that we are all okay with it. Arm's length is also something that our accounting standards require us to look at. And finally, I think the disclosures that are required as per 24, because that is what gets reflected in the financial statements ultimately. You can make additional disclosures for transactions which we think that should be highlighted because they were a one-off transaction, etc., and may be important enough to be reflected to the users of the financial statements.
Share some best practices for verifying completeness of the related party.
So one of the things actually that we also do is send external related party confirmation. So this is one of the external confirmations which Meghdut spoke about. We do external confirmations. I think there is, in terms of best practices, I think this differs from entity to entity. It really depends on how simple or complex the organization structure is. If it's simple enough, it is easy to audit. There is only one parent, there is only one subsidiary, and then that's the end. Where you have various promoters, where you have various relationships, where you have key management personnel which then have relationships in other companies, etc., you tend to then have to start looking at those kind of relationships. What we do, what could be done is look at all of those relationships, see whether there are transactions with those entities when you're looking at your trade receivables, trade payables, you're looking at other auditing steps that you are doing. This is one of the things that we do. We do look at some of these companies which we know are related party, whether you have done repeated transactions with them. If you've done transactions with them, what are the terms, conditions, are they market terms, etc. If all is good, then there's no problem. Nobody stops you from doing transactions with related party, just that you should have everything in place in terms of your approvals. Everybody should be informed well in advance, and things should be at market terms. So those are some of the practices that we follow. And of course, we do send confirmations.
If I could have a follow-on question. Let's say a complex structure like the Hindenburg report which came out, right, which identified a few related parties which auditors currently do not engage with. In such scenarios where we have a vision, 2020 vision here now, what could have auditors done in those cases? I'm asking you a question because it's a very complex structure, right? And auditors, although we are not expected to be bloodhounds,
Yep.
but what are we expected to do in such cases?
So I won't take that as a specific case, but of course, see, like I said, it's management responsibility first, and then you're assessing what management has done, right? And we are not expected to be bloodhounds, so we are not expected to know of transactions which management does not inform us or are not reflected in any financial statement or books of accounts, right? If it's a side agreement which happens and it does not come within your audit scope review, I don't think it is your responsibility to find out that. But something that could have come out through say a bank statement review, a review of your vendor list, a review of the loans and investments that you have given, right? That is expected for an auditor to know, because that is reflected in your financial statements. And that is something that you should have done as part of your audit procedures as professional skepticism. There is some leeway given, but you are not expected to do something that you were not aware of as part of audit scope. I think that is very clear. But all of the ones which were highlighted by NFRA, for example, they said that you would not do your basic questioning on why these funds what was the business reason, terms and conditions, why something was given without security, and really following the trail and saying that, these funds came back from the same entity, how, why, etc. Right? So that was something that you need to question, because that is part of your financial statements, that is part of the bank statements, etc., which you should have reviewed. So that was the basic, and all of this, and all of this should of course be reflected in your audit files, right? Nothing off the record, everything on your file. So the assertion is voluntary of arm's length. The procedure of arm's length and whether things are happening at market and the whole related party questioning of professional skepticism, you would do as per 550. Okay? So if you feel that something is blatantly wrong and they haven't done, then of course that would get reflected. But the statement that some companies make below that related party disclosure saying that all things are at arm's length is voluntary. That's not compulsorily required. It is to the extent that you know that so when you give a loan and investment and you get the approval of the board of directors, you basically put in the fact of why you're giving that loan, what is the security, why is it going to be used, and frankly, if it's your subsidiary, you have knowledge of how that is going to be used, right? I don't think as a parent or something you can say that I don't know what is happening in my subsidiary. So I think that is a little, again, questionable, because you would be preparing consolidated financial statements, you would be having certain key members which may be common within the thing. What procedures you do, whether you get that end-use certificate or you don't get that end-use certificate, I think that differs from engagement to engagement, as long as you can get the information of yes, your funds are being used for whatever purpose they were supposed to be used. But the primary responsibility of end use is with the subsidiary. But of course, the parent would want to know where their funds are being used and if they're going to come back. Okay, those were the two major topics, and I think they were very repetitive in terms of their coverage in the NFRA orders. So almost, I think, 5 or 6 orders had both of these issues repetitive and very much near the theme that we had covered. So let me go to the others, okay, and equally important. Some of them related to accounting standards and some of them related to audit methodology itself. So the first one on my screen here is determination of provision and contingent liability. So what did NFRA have with respect to this observation? I think this observation was mainly with respect to income tax assessment order which came for a particular entity. And in that assessment order, there was this of additional income tax liability which was actually applicable to the company, which was not provided for. So nobody looked at that assessment order, nobody kind of read it and said that, okay, we need to provide for more income tax, etc. So I think what NFRA then reflected is that please look at whatever orders, etc. are coming from the point of recognition of your provision. You have not met the requirements of the standard, because these are all meet the requirement for recognition of provision and should have been there in your financial statements. Reflecting from that, I think one of the important steps that some of our firms do is send external confirmations, right, to legal counsel, which has been employed by the company, which is where basically you come to know if there are any suits or disputes, etc., which are ongoing and which need to be reflected on and assessed from either contingent liability disclosure perspective or even a provision where there is a likely outcome. So that is one thing I think as a step which we found extremely useful, because we do get some surprise answers sometimes which the management have not told us or have not disclosed in their financial statements, and we would kind of want them to disclose either as a contingent liability or as a provision. Go through the log of disputes which the management has shared, and please assess on an individual basis with skepticism of whether something requires provision, requires disclosure as a contingent liability. Do not ignore this only as a disclosure, is what is getting reflected in terms of the observations from NFRA. This is a requirement of a standard, an accounting standard, so you have to kind of comply with it and apply equal skepticism when you're auditing these orders and disputes which the company is ongoing with. In terms of disclosure, of course, then you would have to give a brief description, if it's a contingent liability, etc., of what we are calling as a contingent liability, and a brief description of the obligation. And if it's uncertain, then say that it is uncertain and we are unable to quantify. But if quantifiable, please put amount and timing of outflows. Okay, the next one is with respect to recognition of finance cost and even financial liability. Okay, so I think after NFRA came up with a couple of observations on this, they also came up with a circular in October 2023, specifically discussing this issue. So what they said is that we have observed that when a company has a loan and it has gone to the bank for negotiation, or there is a covenant breach, and you go back to the bank and you say, okay, please waive this, etc. The moment the conversation has started, companies assume that the interest has got waived or my liability has got waived. What NFRA says is that as per your 109 financial instruments requirement, accounting standard requirement, and legal itself, is that legally there should be a contractual obligation that releases you from that interest payment and that liability. Till you do not have a legal contractual obligation which has been agreed between the bank and you, and there's only oral conversations happening of waiver, etc., you cannot de-recognize this finance cost or stop recognizing finance cost and de-recognize the financial liability. So there was various observations that came through, and very recently, I think in March, April, when these observations also came through, that people had just stopped recognizing and accruing interest cost because they said, okay, this is going to get waived in our negotiations, etc. But nothing was contractually agreed with the bank. So that was incorrect, and they said that you are not following the accounting standards, because the accounting standards would require to be legally released from that payment. Only then you can stop recognizing finance cost or de-recognize the liability if that liability is waived. Okay. Don't know why this. Sorry. Okay, then coming to the primary revenue and receivables, which probably we spend most of our time auditing, right? But NFRA also had observations on both of these topics. And what they basically said is that in some of the companies, they do not assume that there is a presumption of fraud in revenue. And why do we have a presumption of fraud in revenue? Because revenue is such an important matrix, right? There's a lot of the whole company's future is decided based on that revenue. So and a lot of agreements, etc., would be linked to that. So there is a presumption of fraud. Because of this, and there was no presumed risk of fraud that the engagement teams had applied, the initial risk assessment that they did as part of planning the audit was incorrect. So the audit procedures, etc., that they applied were also probably incomplete. right? So I think they went down to the audit methodology in this place to say that have you identified your risks in the financial statements appropriately? Have you identified the risk of fraud appropriately, which will then impact your procedures that you run. So if you have a risk of fraud, right, obviously your risk is high, you would get more samples that you would need to test, you would need to do more procedures, etc. on that fraud related. We do certain surprise procedures, we do certain unpredictable procedures, etc. for that fraud, etc. So none of this was identified, so nobody did any procedures with that respect. So this was one of the observations which they identified. So I think please, while you are planning your audit, please keep this in mind in terms of which are the areas where there would be fraud risk, because that would get reflected in the audit procedures that you are doing. The other one was very basic actually, and I think that was even very recently kind of identified. Something that we don't do, or rather don't reflect on, is the accounting policy which is written by the company in their financial statements on revenue recognition. And this may be applicable to other areas as well. But this was an observation with respect to revenue, was not what was followed by the entity. So the significant accounting policy which they stated for revenue was not actually the revenue recognition policy that they were following in day-to-day business. So you did not have a matching of concept, right? So please, when you're reading your significant accounting policies, this is something to keep in mind, that they are meeting one, of course, the accounting standard requirements, which require you, the new Ind AS 115, which requires you to meet certain things. That should reflect in your accounting policy, but of course your business transactions should also be following that accounting policy. Your processes and policies should reflect that. So I think, again, very basic, but something that both the management should have reviewed their financial statements to say what are the accounting policies that we are giving, and of course the auditor, having reviewed the financial statement, should have identified this. Now coming to, I think we've discussed fairly in detail with respect to external confirmations and trade receivables, etc. So I'm not going to get into the procedures, but important thing is that we maintain an external trade confirmation and trade receivable confirmation. Do not go through the management, or basically there are a lot of situations where the management says, oh, okay, we will write to them. We will get it on email and you can use that email as as evidence for your audit file. We cannot use that. I think as a procedure, we are required to compulsorily do external trade receivable confirmations. Okay? If we do not receive them, and which we don't ever receive 100%. Okay? Let's be frank about that. We don't ever receive 100%. We need to do alternate procedures if it does not cover enough. It does not have enough coverage in terms of external trade confirmations. So please do the other procedures. See if you've got the required evidence that you need. If not, please reflect that in your audit report. If yes, then please close and document on your file. So basically there should be a step-by-step evaluation. Trade receivables, how do they, obviously you would have materiality, which is kind of assessed for when you're doing your audit. Your selection should happen based on a method, a statistical method that you use, bearing in mind that materiality and your risk of fraud or whatever risk that you have attached to the revenue and trade receivables. So accordingly, your sampling, etc., would get affected basis that. Now the last theme is also with respect to expected credit losses or provisioning of your trade receivables. So the observation here was that there was a trade receivable which was outstanding for, I think, more than 3 years. And probably only 10% or something was provided. Okay? What the auditor did is highlighted this as an emphasis of matter, because obviously this trade receivable was significant to the financial statement. Highlighted this as an emphasis of matter instead of kind of doing any steps with respect to questioning is outstanding for 3 years. Will I receive? Will I not receive? Why only 10% provisioning? Why not more, etc. And if we did not have enough evidence, then ideally it should, considering the amount, it should be either disclaimed or qualified in your financial statements. Basically, NFRA says emphasis of matter does not bring out anything. It's basically a misuse of just an emphasis of matter, because you don't want to modify your report and you're just highlighting this. You have not got enough information to conclude. Okay. So those are things that basically, again, from a professional skepticism perspective, do keep in mind. ECL as an important concept. You don't need to follow complicated models for expected credit losses, right? That's for banks, NBFCs, etc. But if you are a simple company who knows your trade receivables, etc., you can do a name-by-name assessment. You can do an evaluation on an individual basis and assess whether you need to provide for those things or not. Of course, you need to look at historical numbers, etc. also. But primary being that please do the work. One, management needs to do the work, obviously, and you need to challenge it, whether that work has been done appropriately. And of course, then disclosures need to get reflected if there are any observations coming out of it. Now, this slide has some of the very basics of NFRA observations that came across, and this is relation to audit methodology and the way probably we document in our files. It's not so much a reflection of whether we do something or not. I think it's probably a reflection of are we articulating this appropriately in our audit files. I think the first observation was there was no understanding of business, which was done right at the beginning. And this is something that the automatic reaction was, how can we audit a company if we do not understand their business, right? So it's a reflection of, are we doing enough? First of all, are we having those meetings with the required personnel, etc., right in the beginning? Have we understood the business enough that we can challenge in the areas that we are required to challenge? One being going concern, the second one being related party, etc. Right? Have we got that business understanding? And auditing standards are specifically there for you to get guidance from. One on audit strategy, risk assessment procedures, and response to risk of material misstatement. All of these basically have areas in which how you are supposed to go about understanding the business, which are the areas, how they get then reflected into your identification of risk of material misstatement, risk of misstatement on your financial statements, and how eventually audit procedures are then decided. Right? So this was very basic in terms of an observation, and I think all of us just need to accept the fact that we need to do procedures and then reflect that in the audit file right at the beginning, probably when we meet the client. Determination of materiality, again, there were a couple of observations that materiality was not calculated at all. So then the question was, how did you do your audit procedures if you did not know what was material, what was not material? So again, there is adequate guidance in the auditing standards, please follow. Analytical procedures, again, which was required by SA 520, this was with respect to revenue as well as expenses in some cases. Analytical procedures were not done. So how did you understand whether and why expenses increased drastically, decreased drastically, revenue increased drastically, decreased drastically, etc. So please use analytical procedures, document them, and of course, analytical procedures may need to be supplemented by other procedures, so please do those as well. Analytical procedures on their own may not give you. You could. So you could do it in various ways. It's not simply a comparison of last year, this year. You also do, say my interest expense is supposed to be 10% every month. So you do your own calculation of saying, and if it is not 10% and it's reflecting 20%, of course that's a cause of alarm. So you also do those kind of analytical procedures. It could be done through various IT tools. It could be done manually in an Excel sheet, but basically those are some things that would require to be done. The last one was that if there is an issue, please speak to those charged with governance, and whether it's done orally or it's done in writing, there should be communication of these issues with those charged with governance. Don't stop at the management. Your responsibility is to report something back to those charged with governance. If it's done orally, make minutes of meeting, make whatever document which needs to be done, that you had that conversation with those charged with governance, and put them on file. This was something that was not observed in some of the files.
There's one observation around governance to say that in some cases the communication, 260 communication, was addressed only to the audit committee where it was a listed entity. And I think the observation was that it is the entire board of directors, and in certain cases if the management is
That's right.
responsibility. So do you agree with that?
Yeah, so the thing is that who do you define, first of all, as those charged with governance, right? And sometimes we have a very narrow line of communication where we only talk to the people who are talking to us, like the CFO or something like that. We need to understand that there may be people above who are unaware of this. Again, we presume that people may be aware because they are in the company, right? So there was apparently this exact observation where they said that only the audit committee is not probably those charged with governance. There could be others which you need to evaluate of whether they know of that fact, or are they on the same committee, etc., and whether you have communicated adequately. To that, of course, you need to assess whether you have assessed properly that those charged with governance, etc., but it may not always be, right? Your primary responsibility obviously is to the audit committee because you have that line of reporting, but nothing stops you from talking to the board of directors. And probably that is something that we need to reflect on how audit committee meeting minutes are disseminated amongst the management and amongst the board of directors, and probably we request that these specifically be shared, right, with whoever needs to be shared within the board of directors. So it's just taking an extra step, I guess. I mean, there's nothing wrong with us having communicated with the audit committee, but I think it's important to know that there are other people also in the organization which probably need to know an issue. We've spoken enough about failure to audit documentation. I think this applies across areas. Okay, this has been repeated in almost all the orders, that things that were done, things that the auditor claimed they had done, probably were not reflected enough in the audit documentation and therefore concluded not to have happened. Failure to use the internal audit report I spoke about. This is a very important input that we sometimes miss out, because the internal audit and the concurrent audit have more scope in terms of daily activities. We as external auditors do not probably cover daily activities in as much detail. So their observations, they are also required to now report to the audit committee, etc., and the board of directors their findings. So I think these kind of observation and these kind of minutes of meeting, etc., become important for us to review. This becomes easy tells for us in terms of where the issues lie. I think EQCR was one of the very initial orders of which the initial stream of orders where I think this was observed as a continuous observation. One is that there is not enough EQCR involvement throughout the audit. You have hired an EQCR, but we cannot evidence that that person was there right from the beginning till the end. You know, so again, this calls for our kind of thing of how we involve. We have an extra person who has to look at the financial statements, challenge, do their respective duties to the engagement partner. So involve them at the correct time, document that they were involved in terms of the initial planning meeting, your identification of risks. After you've done the audit procedures, if you've identified any issues which you need to highlight, and of course, finally, the review of the file and the review of the audit report. So I think the theme was that the continuous involvement of this was lacking. So this needs to be upped in terms of involvement and EQCR in a timely manner. Very recently, there was an observation on joint auditor. Okay, this may be applicable in some cases, not in all cases. The observation was twofold. One was, one kind of observation was that the management had decided which areas would be divided between the two auditors. Ideally, it is the joint auditor's responsibility to divide their areas between themselves. Management has no say on who will do what. So that was one observation. The second one was that there were two auditors. There was two auditors. There are certain areas which both auditors are responsible for if they are not divided. One set of auditors highlighted some issues like, say, a going concern or related party. I don't know what that was. They highlighted those issues, but the second auditor did not basically do anything. They did not go through those points which were highlighted by the joint auditor, etc. They say that it is both the joint auditors' responsibility on these areas, and they should reflect each other's work. Okay, so those were the two observations on joint auditors. Okay, the last set of reporting responsibility, and this is one of them is kind of one which I'll just spend 5 minutes on, is emphasis of matter. What was observed that the emphasis of matter paragraph was highly misused by a lot of audit firms. Basically, this was the in-between way that audit firms used, that engagement teams used, not to modify the report, but to highlight something in their audit report, which basically NFRA said it was incorrect, and I think I discussed one where ideally it should have been a qualification, but they had put an emphasis of matter. Please reflect if something is incorrect. Please say it is incorrect. Qualify your audit report. If you've not got information, please disclaim and mention that so that the audit report is modified. Do not find an emphasis of matter as a way out to reflect, to highlight something to the users of the financial statement, because that does not give any understanding to the users. It basically just goes back and refers back to the note that the management has made. Obviously, the management is not going to say in their financial statements that something is wrong or that you have not got enough information to audit it. So please reflect either as a qualification or as a disclaimer. And in various of the cases, they have actually given examples that this should have been modified instead of giving an emphasis of matter. Right? So don't find emphasis of matter as the middle way. Emphasis of matter is only used as a highlight point for something that you know has been appropriately accounted for, but should be brought to highlight to the financials just as a matter of emphasis. Also, I'm not sure whether I mentioned it, if there are inadequate disclosures in any of the accounting standards, it could be going concern, related party, or something else that you've identified, those will also have to reflect as a qualification. So do keep that in mind. Either the management gives a complete disclosure. If they haven't given a complete disclosure as per the accounting standard or any other auditing standard requirements, you need to then qualify and mention that in your auditor's report. So your auditor's report basically becomes your responsibility to have everything there that you have not received information on. Some of the other subtle points which were highlighted is that the financials were not approved before you signed the audit report. So do make sure that when you are signing an audit report on the financial statements, the audit report, the financial statements are signed with you. Right? There was, I think, mismatch of dates, etc. Another thing that was also highlighted as part of audit documentation is that once your audit report and everything is signed, right, the audit assembly date is finalized, there were situations where they identified that documents were altered or opened or changed, etc. So I think the highlight there is after you have signed off on your financial statements, you cannot go and change your work papers, etc. for grammatical mistakes. I don't think they care about, but numbers, etc. shouldn't change. Yep. Okay, emphasis of matter we talked about. And lastly is, do make sure that the annual report, some information which is basically consistent in your financial statement and annual report are not inconsistent. There have been situations where the annual report says something different, which is probably the director's report, and the financial statements say something different. Right? You have that the paragraph where you're required to review the other information of the annual report, etc., in terms of numbers and things. So make sure that there is no material inconsistency of what is getting reported in annual report versus the financial statements. And lastly, management representations cannot be a replacement of audit procedures. You do take management representations for some things, but that doesn't stop you from doing your audit procedures yourself. Do not accept that as a instead of audit procedures. Okay, that's all I had on the NFRA orders. Any questions? Okay, thank you. Yep.
Recently there was a news item, NFRA having imposed penalties in respect of wrong certification of income tax deduction under section 80JJ. So, can you reflect whether NFRA has jurisdiction over income tax certifications?
So certifications is again something that an auditor does, right? And it's a review of a certificate, which again is an auditor's responsibility, and it is something that NFRA is reviewing of auditors. So that's why when you issue certificates also, please be careful of what we are certifying, whether we are doing enough procedures, whether we have looked at enough information to certify that certificate. Because certificates was something initially which we used to very easily kind of, give information on and etc. But I think it's as good as doing a audit procedure on and making sure that we have got enough information to certify on something. So there are a lot of places that we get requests for certificates where we've not even audited the underlying financial information, and we are supposed to give a certificate on, say, a net worth or something based on unaudited numbers. And we have to say no, because we basically say that we have to do minimum procedures before you can issue a certificate. We can't just issue a certificate because you've given us a piece of paper with statement of assets and liabilities written on it. So we need to be careful, because certificates was an area where we used to take, again, as auditors, take it very lightly. But we have the whole guidance note from the institute, etc., which lays down a lot in terms of what procedures to do, whether we are giving limited assurance, we are giving reasonable assurance, etc. And I think that again needs to be looked at very closely.
Second question. There was another again very top line in the newspapers. NFRA imposed penalties on 18 auditors, 18 branch auditors of DHFL. Any reflection on those orders?
So DHFL was one of the NFRA orders which also came out, and they did publicize that. I think it was in December 23 or something, and there were a huge list of observations. So now, of course, they would have done branch audits as part of their scope, etc. And based on the observations and the issues that they came out of, like I said, every order also has the penalties and charges which they impose either on the audit firm or the engagement partner or whoever the auditor was at that point of time. So as part of that, they have reflected that in, yes. But that is within, again, their, when they do a financial statement, the branch audit is part of it, so. Cool. Thank you.
Thank you, madam. It was a nice session given by CA Lamiya madam for sparing her valuable time and enlightening us on the topic. I request all the members to present a hearty vote of thanks with a huge round of applause. Thank you. We take a 45 minutes lunch break and reassemble back.